Danielle, happy Friday. Thank you for the early wake-up call. Let's talk about the jobs report. You join us often to preview it. What are you looking for that will stand out this time around?
Well, I'm going to be paying pretty close attention to the sectors that are affected. I was surprised in the ADP report to see construction come in as weak as it has. Residential real estate has been a bright spot for the U.S. economy. The housing market, Chairman Jay Powell alluded to that in the press conference on Wednesday. So I'll be paying close attention. We're expecting manufacturing to be weak. We know that General Motors is going to shave at least that 46,000 jobs off of the top line. The Bureau of Labor Statistics estimates that 7 indirect jobs are affected by every lost auto job. So I will definitely be looking for any signs of seepage into the services sectors, with transportation and construction being at the top of my list.
So Danielle, I mean, is it fair to say that this will be a noisy report, so to speak? Is there something that we have to kind of sift through? You mentioned GM, you mentioned some of the other kind of nuances about this particular report. But with the headline number, if it does come in at 90,000, it represents a pretty significant slowdown. Does this mean we are truly late cycle in this economic kind of development?
Look, Dom, I don't think there's any doubt that we are late cycle. Quill Intelligence ran an analysis of the ADP data, and last October at this time, there were 250,000 jobs created. Cut that in half. And in fact, the run rate over the past 6 months has been cut in half from that preceded it. And the only sector that added was financials and large services firms. Every other sector and every other size business has seen a dramatic slowing over the past 6 months. We've seen layoffs kick up with Challenger. There were healthcare jobs, technology jobs that were topping the list of October layoffs. So I don't think there's a doubt that we're very, very late cycle. I'd be surprised if we didn't have downside risk to that 90,000 that's expected.
All right. So given that forecast, given the thought that you have here that we are late cycle, there is downside risk. Did the Fed do the right thing this week when it took its third step in cutting interest rates just since this summer?
Well, I think that the market pricing was almost 100% for that Fed move, and I do think that was the right thing for the Fed. They would have shocked markets had they not done that, and they are trying to get a boost out of interest rate sensitive sectors. In fact, we'll see car sales out later today, not from the big three. They now only report on a quarterly basis, but I'll actually be paying closer attention to that. And I think if I'm Chair Powell, I might even sleep through the non-farm payroll report, because the key, I think, for investors this morning is going to be that ISM report that follows it. Let's see if we have 3 straight months of declining new orders. That is a trend that's going to back any weakness that we're seeing in the labor market.
All right, so we have generally strong but slowing economic numbers compared to the rest of the world, but there has been a view from certain manufacturing indicators, from even service indicators, that this is a definite slowdown, a contraction. So if you are in a situation like this as a central banker in America, what is the appropriate course of action in the coming, say, 3, 6, 9 months?
Well, this is the conundrum, because I think that Powell has backed himself into a corner by saying that he's going to be data dependent on steroids. When you have a number like the Chicago PMI come out and you see certain indicators inside of it sink to multi-cycle lows, as we saw yesterday morning, and this did not include, by the way, the effect of the General Motors strike. But that is going to make that's going to make investors and market watchers that much more sensitive to every single data point that hits the wires. And every time there's a disappointment, they're going to look straight to Jay Powell and say, where's my next rate cut? Even though he made it abundantly clear at the press conference, he does not want to continue cutting rates. He wants to shift the easing over to the balance sheet and continue growing it and not cut rates anymore. But again, I think he's backed himself into a corner.